Hello everyone. In this video we're going to take a look at Chapter 6 in our financial accounting class, which is a continuation of our discussion about merchandise inventory. So our learning objectives for this chapter are, we're going to take a look at some accounting principles and controls related to inventory. We're actually going to look at accounting for merchandise inventory costs in a periodic system. It's the same concepts as you would use in perpetual, except they're a little bit simpler. And then we'll look at the effects on the financial statements using different inventory costing methods. And then finally we'll look at inventory turnover and days sales in inventory. So by way of review, remember that merchandise inventory is goods that a company has bought or manufactured for resale, but they have not yet been sold, right? They're still on hand. And so if you're a manufacturer, it could be raw materials and work in process. If it's a merchandising company, they're going to have inventory that they bought. Merchandise inventory is reported on the balance sheet as a current asset. Now, when the inventory is sold, it becomes an expense. It goes to cost of goods sold on the income statement. Sometimes students forget that cost of goods sold is an expense because it doesn't have the word expense in it, like say advertising expense, right? So remember that cost of goods sold is an expense, generally the largest expense for a company that's a merchandising company. So a few principles and controls. The consistency principle says that if a company has a choice, they have to use the same accounting principles and procedures from one period to the next. So we're going to be looking at inventory costing methods. The company should use the same inventory costing method from period to period. And then they should disclose what inventory costing method they used, because the disclosure principle says that companies should disclose all of the information that the readers of the financial statements would need to make a decision. And then finally, the materiality concept says that you really only have to follow accounting rules strictly if an item is material, meaning if it's large enough and significant enough to make a difference to a financial statement reader. So the example I like to use is that, let's say that Apple buys a wastebasket. Well, technically that's an asset that should be put on the balance sheet and depreciated over its useful life. But of course, one wastebasket or even 100 wastebaskets are not relevant to any reader of Apple's financial statements because the numbers are so small. So it's perfectly fine for Apple to record that wastebasket as an expense. All right, so they don't strictly have to follow the rules. All right, so a simple way to remember how to calculate cost of goods sold is beginning inventory plus purchases minus ending inventory equals cost of goods sold. For some reason, I remember walking around saying that to myself as a student. So beginning inventory, add in all the purchases that they had during the year, subtract out what you have left, and that gives you the cost of goods sold. Now let's look at that in a little more detail. So let's say a company begins the year or the period with inventory of $25,000. That was last year's or last period's ending inventory, right? So that's going to match up to last period's ending inventory. So they have beginning inventory of $25,000. Let's say they buy inventory for $100,000 during the year. That gives them cost of goods available for sale of $125,000. This is exactly what it sounds like. It's the cost of all the goods that they had available to sell to customers during the year. So everything they started with and everything they bought. Now, at the end of the year, where did that cost of goods available for sale go? There's two possibilities. Either the goods were sold or they're not sold, right? At the end of the year. Whoops. All right. If the goods are not sold, then they will be in ending inventory. Remember, that's the cost of unsold merchandise. If they are sold, they're going to go to cost of goods sold. So this formula works for every company. Beginning inventory plus your purchases gives you cost of goods available for sale. Either goes to ending inventory or it goes to cost of goods sold. Remember that ending inventory is a current asset on the balance sheet, and cost of goods sold is an expense on the income statement. Now, we're going to use inventory costing methods to determine how much our ending inventory and cost of goods sold are. Let's see why. All right, so let's say that we're doing an inventory for the third quarter for a company, and they started the third quarter, July 1st, with 20 units of inventory that cost them $210 each, so $4,200. They had 2 purchases during the quarter, so for the quarter they had 90 units and $19,480. That is their cost of goods available for sale, right? So $19,480, 90 units cost of goods available for sale. Now, on September 18th, let's say they sell 10 units for $350 each, so the company gets $3,500. That is their revenue, right? Their sales revenue. Now the question is, which units did they sell? Because when they go out to the warehouse, let's say these are printers. Imagine that they're printers. So they go out to the warehouse and they see 90 printers all piled up. Their records tell them that the printers cost them a total of $19,480, but they have no idea which units are which. All right? So that's when we need what's called a cost flow assumption, or an inventory costing method. We have to make some assumption about which units were sold because we don't know. All right? That's key, because a lot of times students think that we're talking about selling particular items, but we're not. We're making an assumption that particular items were sold. So we have 3 different inventory costing methods we're going to look at. We have FIFO, which is the first in, first out. We have LIFO, last in, first out, and then we have average cost. So let's take a look at FIFO. FIFO says the first units to come in are the first ones to be sold. All right, the first ones that we bought are the first ones to be sold. So the first ones we had here, the oldest ones, are from July 1st. So we're going to assume that the 10 units that we sold came from this purchase here, or this beginning inventory. So it cost us $10 units times $210, so our total cost is $2,100. Remember, our sales revenue is $3,500. Our cost of goods sold is $2,100. So that gives us gross profit of $1,400. This is what will be reported on their income statement. Now, what's left at the end of the year is everything that wasn't sold, or the end of the quarter, right? So our ending inventory, we still have 10 of these left, and then we have all of these other units left still. So at the end of the quarter, we have 10 units plus the 40 plus the 30. So we have 17,380 left. Notice that in every case, no matter which inventory costing method you use, your cost of goods sold plus your ending inventory equals your cost of goods available for sale. Go back to that other slide in case you forgot that, okay? Remember, cost of goods available for sale is equal to ending inventory plus cost of goods sold. All right, let's look at LIFO. So LIFO assumes that the last units to come in are the first ones to be sold. The last ones to be purchased are the first ones to be sold. That doesn't necessarily make any sense. There are certain cases where it does, but it doesn't necessarily make any sense because most goods flow FIFO. But remember, it has nothing to do with the actual units. It's a cost flow assumption. So that would mean in this case, the cost of the units that we sold is $10, 10 units times $220, or $2,200. So in this case, our gross profit is $1,300. What's in ending inventory? Everything else. So these 20 are in ending inventory, these 40, and then 20 are left from this purchase here. And so our ending inventory is $17,280, and our cost of goods sold is $2,200. Notice the numbers are different. It's exactly the same circumstance. The same thing happened, but we're accounting for it in different ways so that the numbers are going to show up differently on the financials. So finally, let's look at average cost. And what we do is we find a weighted average. And the reason we find a weighted average is because we bought different numbers of units at different prices, right? If all these were 20, then it wouldn't matter, but we bought different quantities. So to find the weighted average, you take your cost of goods available for sale and divide it by the number of units that were available to sell. So we have our cost of goods available, 19,480 divided by the 90 gives us 216.44. So remember our cost of goods sold is going to be 10 units times 216.44. And so our gross profit is 1336. Our ending inventory is going to be 216.44 times 80 units that are left, which gives you, this is rounded up, 17,316, because we do want these two to add back here, right? So there's a little bit of rounding there. Okay, so those are our three inventory costing methods. Here's a summary of the numbers. Now, these could be there could be a much greater variety. There wasn't a big difference in the prices here, but if there were, you could have big differences here. But notice that all of these are possible ways to report this. So all three of those could be on the balance sheet. All three of these could be on the income statement. Whichever method the company chooses, they should keep using that method for consistency reasons. All right, so as far as the tax, the tax and the financial statement effects, notice that in this case prices were rising. Notice that LIFO gives the company the highest cost of goods sold. That means the net income is going to be the lowest, and they're going to pay the lowest taxes. And that's why some companies choose to use LIFO. FIFO is popular because it does match the physical flow of most goods, right? And then the ending inventory reflects current costs. The government says, look, if you're using LIFO on your tax return because you want lower taxes, you also have to use it on your financial statements. All right, so finally, let's take a look at inventory turnover, which tells us how fast a company sold its inventory. Generally speaking, higher is better. Now, it could be that too high would not be good, because that might mean a company might have stockouts, right? They won't have the inventory to sell. And too low could be a problem because it means that they're not selling. Every time you sell your inventory, you're making profit, right? So if you're not selling your inventory, maybe the inventory is old, it's the wrong inventory, too much inventory. So our formula is cost of goods sold divided by average inventory. Average inventory is beginning plus ending divided by 2. And then days sales and inventory says, well, how many days of sales do we have sitting in our warehouse, in our inventory? And generally speaking, lower is better. And our formula is 365 divided by the inventory turnover. Let's take a quick look at an example here. Let's say that Chic Apparel has these numbers. They have beginning inventory of 156,000, ending inventory of 179,000, and their cost of goods sold for the year is 837,500. So first thing we have to do is find our average inventory. So remember, our average inventory is beginning plus ending divided by 2. So we calculate that out. It comes to 167,500. So our inventory turnover is equal to cost of goods sold divided by the average inventory. So it's the 837.5 divided by the 167.5, which gives us 5 times. So that means they turn over their inventory 5 times a year. Now, how many days sales do they have in their inventory? We're going to take the 365 divided by the inventory turnover, and that tells us how many days. So that gives us 73 days. So that means this company has like 2.5 months worth of inventory on hand. Whether these numbers are good or bad, a lot of it depends on industry standards. Some companies, like a grocery store, would be expected to have a very high turnover. An airplane manufacturer would be expected to have a very low turnover, right? So you always would want to compare numbers to other companies in their industry, to their competitor, and then to the same company's numbers in other years. All right, that's all we have for this. Please take a look at, there's a video about cost flow assumptions that will help you if you want some more practice with the FIFO and LIFO. See you next time.